long-term yield represents a kind of sort of average.
But that GDP ratio, we don't need to worry about that. That doesn't say much.
Well,
Paul is really very, very experienced and respect Australian American economist. And he is respect observer of U.S. economies of U.S., Japan, and China. And he is expert on Japan's monetary policy and the last decade, also expert on U.S. economy. During the financial crisis, Paul was the chief economist of Lehman Brothers. And of course, he observed China's economy very well too. And just he holds many numerous positions. Up recently, he was a senior fellow at Howard's Kennedy School and vice chairman of S&P Global. Welcome, Paul.
Oh, thank you, Susan. Always a pleasure to be here and to be with you.
Yeah, and most important thing I did not say, he's author of Wall Street Journal bestseller, The Power of Money, which we are going to talk about today. Great. Paul, everyone here, we know that many of us, pay a lot of attention on financial market. Recently, there is a turmoil in U.S. bond market. The yields on 10-year, 30-year yields increased dramatically. Just the 30-year yields top 5% in May. So it seems a lot of worry about this. One of that reason is because the so-called One Beautiful Bill, the passage of this bill will increase deficit by $4 trillion. So many people are worried about the level of the U.S. debt. But in your book, you mentioned that government truly doesn't have to pay off that debt. So what do you mean by that? How do you reconcile with the concern we all have?
Well, just on the Treasury yields going up, perhaps I should just say a little bit about that. And when I hear these kind of stories, I'm not following the markets on an hour-by-hour basis anymore. I used to do that. But people talk, the yields are going up dramatically, and you look at it, and I don't really see that as much. So if you look at the 10-year Treasury yield, I think it's around about 4.4% today. But the federal funds rate is still sort of stuck around 4.25% to 4.5%, so 4.5%. So in other words, the 10-year Treasury rate is pretty much in line with the federal funds rate. And what that really tells you is that it's not so much that the 10-year Treasury yields are very high, it's rather that the federal funds rate is quite high. In fact, the Federal Reserve, in its own kind of communication to the market, is signaling that it expects the federal funds rate to come down to about 3%. And the theory of what determines long-term yields, say 10 years or even 20 years, 30 years, as you mentioned, is, I won't get too academic, but it's the term structure of interest rates, which basically says long-term yields represents a kind of sort of average expectation of the market of the future course of monetary policy or the federal funds rate, the overnight rate, the short-term interest rate. It sort of basically discounts all of that to get to the long-term rate. In other words, if the market's expectation of the future path of the federal funds rate changes either down or up, that will be reflected in long-term Treasury yield. So it's rather that, the course of monetary policy, rather than concerns about the level of debt, for example, or maybe the US defaulting on its debt, which I don't think will ever happen, that determines the long-term yield. So you might say, well, why is the federal funds rate still so high? There are inflationary pressures in the economy, and you mentioned the big beautiful bill. That would also cause the market to expect further pressures on the economy from upward inflation. Now, the Federal Reserve's job is to offset that with monetary policy.
But you indicated the size of U.S. debt is not a problem, but it's against a lot of people's thinking.
Okay, so let's come to the fun part, which is the government debt. And that's the first problem is one of language, that we call it, and I'm using the term here as well, government debt. So when you say, well, if it's debt, debt, by definition, has to be repaid. And in actual fact, I would counter that, and there's a whole long chapter, probably the most difficult chapter in the book is chapter 2, get the difficult stuff out of the way up front, that sort of argues, and I'm not the only person or the first person to make this argument, there's a school of thought in sort of monetary economics that really agrees with this proposition, that we shouldn't really think of government debt as something that has to be repaid in the way that the debt of a household has to be repaid. And at this point, I usually reach into my pocket and bring out a $20 bill. And the quickest way of understanding that government debt doesn't have to be repaid, doesn't mean there could be other issues associated with it, inflation in particular, is to sort of get your head around the fact that what we call government debt is really another form of government money. And this is like the most basic form of government money. So this is a $20 bill. And if you look at this closely, it says, "In God we trust," but it's more in the Federal Reserve and the government we trust. This is a liability of the Federal Reserve. And the Federal Reserve is part of the federal government. And as if to prove that point, this is, if I said to you, who signs this $20 bill? You'd say, well, the Fed chair, presumably. No. Actually, it's the Secretary of the Treasury.
Yeah.
And another position called the US Treasurer, not the Federal Reserve chairman. And this is a liability of the federal government. If you took this liability, this debt, and went to the Federal Reserve down the road, or to a bank and said, I want my money, I want this repaid, I want this to be paid back to me, and you handed it over, the teller would take it and give it back to you. That's because we live in what's called a fiat money system. Money is just a collective sort of social contract or understanding among people that this will have $20 of value. We can buy $20 of goods and services. Now, $20, let me leap now to $36 trillion. The $36 trillion of government federal debt that we hear about and people worry about is just kind of like that. It's just a much bigger number. Now, to explain how it's like that, you probably need to delve into chapter 2 in the book. It's a little bit complicated. I don't think we have enough time. But one other thing I want to point out, Susan, is we get a little bit tricked as individuals about these magnitudes. $36 trillion sounds like a lot. The first thing to notice is that, a little bit technical, some of that debt is actually held within the federal government. So it's like you owe something to yourself. And if you net that number out, and this data is readily available, but most people quote the big number, not the smaller number. The smaller number is about $28 trillion. Now you might say, yes, Paul, but that's still a big number. It is. But guess what? The US economy is a very big thing as well. And US GDP now is about $30 trillion. So the amount of debt that's really outstanding in the hands of the public is roughly equivalent to the size of the economy. So putting it in perspective,
but the debt to GDP ratio is around 121%.
Well, that's the 36 trillion.
Yeah.
What I'm saying is you're probably better looking at the 28 trillion number, which is about 100%.
But you also mentioned the debt to GDP ratio. We don't need to worry about that. That doesn't say much.
Well, it's everybody kind of worships at the altar, when we have this discussion about fiscal sustainability of the debt to GDP ratio. And it's the debt to GDP ratio is really apples and oranges. First of all, it's not a percent. And I used to be an academic, so I kind of get, you get this itch when people are using the wrong units and getting apples and oranges mixed up. Why is that? Debt to GDP is a stock, the stock of debt, let's call it 28 trillion, divided by a flow, which is GDP. GDP is the amount of goods and services produced per unit of time, a year. So it's a dollar amount divided by dollar per time period, usually a year. If you do a little bit of algebra, the dollars cancel, the T comes up the top. So it's basically the unit, the correct unit for 100% GDP ratio, debt to GDP ratio is 1 year equivalent of GDP. So that puts it in perspective. If you like, you could say, well, if tomorrow or next year the entire debt of the federal government had to be repaid, kind of in a sense repaid to itself, but anyway, that would consume 1 year of GDP. Now that's not actually so much when you think that the US economy has got, lives forever. So it's 1 year, okay, but I've got like another 1,000 or 2,000 or 5,000 years. But the most important thing is the first point, Susan, that it doesn't have to be repaid. So, it's a metric, but we should be very careful about using that metric and saying, oh, above 100%, now we're destined for, doom and gloom.
But you mentioned that, first the debt doesn't have to be repaid, and then the GDP ratio, GDP to debt issue is not concerned. But to what degree, the large amount of debt is a problem that need to be concerned, need to be solved, need to be do something about?
So I would point out two, and this is again mentioned in the book. I mean, we could have a longer debate. You could add it to this list, but the two ones, and the most important one, is inflation. Government debt is the stock that results from governments running budget deficits, and a budget deficit, so it's around about at the moment 6% of GDP. So that's it's about it's a few $1 trillion. It's a decent sized number. That means the government is writing more checks into the economy for pay civil servants, for defense, for Social Security, Medicare, all these expenses, writing more checks into the economy than it's withdrawing from the economy by taxation. So it's a net injection of money into the economy. Money that always stays there, but it's still money, it's purchasing power. And one of the most basic dictums in economics is if you print too much money, the economy can't keep up with that, you will get inflation. Now, this is not just a theoretical exercise. We just had exactly that situation happen. Post-COVID, the government printed a lot of money, ran a big budget deficit, and suddenly inflation took off. So sometimes when you say the debt doesn't have to be repaid, people say, oh, Paul Sheard said debt doesn't matter. No, it does matter for a very important fact. One is inflation. That's the most important. And if the government keeps printing too much money and the Federal Reserve remains independent, some people worry about that as well, but let's take that for granted at the moment. The Federal Reserve's job is to offset that inflationary pressure with higher interest rates. And higher interest rates, higher than they need to be, will have a detrimental effect on investment and the economy. So it's a good reason not to do it in the first place. The other reason is a bit more philosophical and even maybe political, which is that if you have a big budget deficit, a lot of debt building up, you're probably in an economy where the government is writing a lot of checks into the economy, and in other words, is a big part of the economy, and is maybe crowding out the private sector as well. So, on the political spectrum, you will have people at one end who want a small government, less intrusive. At the other end, maybe a government that is more activist, more intrusive, more interventionist. And that may be reflected in having higher budget deficits and higher stock of debt. So that's a philosophical or political debate that there's no absolute right and wrong, I don't think. It's something that has to be decided in the political arena.
So in your opinion, the current size of US debt should not be a problem?
Well, I'm not worried about it from the viewpoint of, oh my conscience, this money is getting more and more, this mountain of debt is building up, and that is going to be a burden on future generations. Because they're going to have to repay it. We have the same debate in Japan, where the fiscal metrics look even worse. Like that number that you quoted of 120% is more like 240%.
But in your book,
but that's not something that
you said the debt will not pass down to the next generation, which is not, most people think that way.
No, I didn't quite say that. But no. So if you look at it now, again, we have this narrative that, and you hear this all the time in the political debate, that this 36 trillion, because that's the number that gets cited, is going to be a burden on our grandchildren. I already have some grandchildren. They seem to be doing okay. And that's wrong. Because, again, why is that wrong? A couple of ways of looking at this. What we call government debt is an asset for the people who hold it. So many people will have treasuries in their portfolios, either directly or they'll have it through the 401k funds or other investment funds. So let's say that the next generation, just freeze things right now, the next generation the government will have this 36 trillion of debt. The next generation will have 36 trillion dollar for dollar of assets. So in an intergenerational effect, the debt and the assets kind of just cancel out. Now, there's one footnote there, which you're probably going to jump in.
Because the government will collect a tax from, because there's a huge debt. In order to pay the debt, government may need to collect tax from future generations.
Well, no, again, I would look at it, I would see that differently, Susan, and say, if there's too much purchasing power transferred into the future, and the future generation says, oh, we inherited all of this money from our parents. Some of it might be stock market wealth, but let's just focus on the government debt. This is, they call it debt, but for me, it's an asset. It's money. I'm going to go out and spend that money. And if too much of that purchasing power is released into the economy all at once, you'll get inflation. When you get inflation, you need to tighten monetary and fiscal policy. Maybe the Fed shouldn't do all of the work. And one way that the way you tighten fiscal policy is by either cutting expenditure or raising taxes. So at some point in the future, again, if I was transported 100 years, 200 years into the future and was an economic advisor, and we woke up one morning and there was a burst of inflation because everybody's spending their treasuries, I might say to the government, well, here are your options. And one of them is to withdraw some of that money through taxation. And you might say, well, that looks a little bit like repaying the debt. But it's a different kind of context. The last point I'd say is, the second point I wanted to make is, and I make this point in the book, what really is going to influence the welfare of our grandchildren and further generations is the stock of productive assets that they inherit from prior generations. And that's the physical capital, all of the factories, all of the infrastructure. But it's also the skill and the know-how and the stock of scientific knowledge. And so the future, the grandchildren come into the world and they really haven't done anything yet. And they inherit a world which has an incredible productive capacity. And so it's sort of a race between the amount of purchasing power that is being inherited and is being generated and the ability of the economy to generate the goods and services that will be demanded when that purchasing power is spent. And I'm a little bit on the optimistic side in terms of thinking that, yes, the debt is building up. That means money for future generations. The ability of the economy to generate goods and services is very, very high.
I think this optimism is very, very necessary because we witness just so many crazy things, in this negative world. But a lot of people in the financial world, they do worry about big name like Ray Dalio. He always worried about this debt issue. I always think we will have debt crisis. And Jim Dimon, who also warned we may have the market breakdown. So against this, the very related question, which relate to the turmoil of bond market and the size of U.S. debt, is the U.S. dollar as a reserve currency. Does all this affect the U.S. status as the world's dollar status as the world currency, a reserve currency?
Well, again, depends what you include in all of this. There are reasons to worry about the reserve currency status of the dollar, but I don't think, again, the size of the debt is really one of them. In fact, some people would argue the other way around, that part of being a reserve currency is that the rest of the world wants to hold dollars. And let's not forget that in finance, we call treasuries the safe asset or the risk-free asset. That's kind of the way we think about government
recently
debt
the
in
market,
finance.
the market turmoil, a lot of people adopt the dollar's, status as a safe haven status.
Yeah, again,
People
to tell you the truth,
adopt the.
Well, but to tell you the truth, Susan, I don't really see turmoil in the Treasury market. Maybe I'm missing it. I'm looking.
But Moody
in the wrong
also
place.
stripped downgrade U.S. debt rating.
Well,
right?
all of the three major rating agencies, S&P was the first back in 2011, and then Fitch a few years later, and then just recently Moody's. I think they're all at now AA plus. Now you can argue, is that the right rating or whatever, but I would just observe that a AA plus credit rating is extremely good credit rating. Of course, it's not. It's one notch below AAA, but again, in terms of maybe the reserve currency issue, we toss the word reserve currency around a lot, and the U.S. is the predominant reserve currency in the world. But what does that actually mean? And reserve currency has two or three different kind of aspects or meanings, which we probably need to sort of unpack a little bit and look at each of those kind of in isolation. The reserve currency, the most fundamental idea of the reserve currency is really that a lot of governments or central banks around the world accumulate foreign exchange reserves, and they're predominantly in dollars. Now that is about 58%. It used to be much higher. So that number is coming down a little bit. In other words, central banks and governments, when they hold reserves, foreign currencies as kind of good, safe, liquid assets, that is becoming a little bit more diversified. The euro is now about 20%, but then you go down to the sterling, and then renminbi, tiny bit, yen, 4% maybe, etc. And then there's the reserve currency in the sense of a financing or an invoicing currency. We look at gold and commodities in dollar prices. Companies that are doing international finance will often raise money in dollars and then spend it in dollars to buy capital equipment, etc. So the dollar as a reserve currency has different kind of aspects to it, and they're kind of influenced by different factors over time.
Trade war also doesn't help, right? Trade war also
the trade war, that's another big topic. The thing that I've taken issue with, and in the last chapter of the book have some mention of, is I'm not a fan of weaponization of the dollar. That is, weaponization of the reserve currency status. The fact that the rest of the world wants to hold dollars and uses dollars. Just then turn that around, and the US has a very strong army, navy, marine, a military capability. To extend that into the financial arena and to use financial sanctions and to be freezing, if not seizing, foreign exchange reserves, shutting banks of other countries out of the global SWIFT banking system, I, as an economist, say that's very, very dangerous. I mean, it's sort of like, to a certain extent, unnecessary. As I said, the US has enormous military power. Nicer if they don't use it, but it's there. But that does, I think, that is the thing, rather than the debt per se, that potentially puts the reserve currency status of the dollar at risk. Not today, not tomorrow, but over a longer term, because you can't have what the French finance minister in the 1960s called the exorbitant privilege of the dollar, as the US having that exorbitant privilege of it being the reserve currency, without also having some extraordinary responsibility.
Yes, the credibility. Right?
Those two things go together.
Yeah. Then let's talk about the trade war. Paul, you wrote once wrote that there is Trump may have logic. Help us understand the Trump's logic to start the trade war, because you once wrote that the global trade system, after World War II, that American built, is not sustainable because America is not as powerful and as rich as it used to be, cannot keep opening its market without get something in return. So do you think Trump has a point that the system is unfair to the United States?
Well, it's a great question. I'm not sure if I'd use the word unfair, but I would say that I think, and again, as an analyst, what I try to do is I look at these developments and try to make sense of them, and rather than getting caught up in the emotion and the politics and whatnot. So you might say, I've been trying to make sense of Trump. And one way to make sense of it is to say that what the President Trump is, and Trump 1.0 and also now Trump 2.0, was sort of railing against the system. I mean, he sort of inherited this system. He's now the commander-in-chief. He's now the president, the most important position in the world, and saying, so what have I got here? And he looks at it and he says, hold on, this doesn't make sense. And what doesn't make sense? The bigger picture to me is that the era of Pax Americana, call it Pax Americana, has kind of reached, run into some challenges, or sort of, kind of come to the end of its useful life as it was constructed. Now, what is Pax Americana? I think it has sort of, in a nutshell, it's the idea that the US as a sort of global, benign, or the most powerful country in the world, a benign hegemon, let's call it. Some people say it's not so benign, but let's call it, has good intentions. It's sort of trying to help kind of run the world. That was the system of the post-war era up until fairly recently, maybe up to last 10, 15 years. And there were two elements of that. One was the idea that the US was kind of the policeman to the world, sort of guaranteed global safety and security, open sea lanes, and let's keep everybody well behaved. The other was to underwrite what is sometimes called the liberal international order, to be the keep its markets open to in the post-war era, Japan, Germany, Europe reconstructing, China when it entered the WTO, and basically saying, we will take your goods, and not necessarily demand reciprocity. And as an economist, I would describe this as the US was big enough, after the Second World War, about 50% of global GDP, was big enough that it could supply these global public goods, policemen to the world, underwriting the global trading system, because it was big enough to internalize those costs of providing public goods. The problem with public goods is, a little bit of economics here, somebody has to bear the cost, but the benefits are spread widely. So you tend to get under-provision of public goods. But the US, being the sort of global hegemon, was able to provide those public goods because it was big enough to enjoy the benefits itself, and also have power and prestige in the world. So fast forward to like now, when we're here at the China Institute, the biggest change in the world is the rise of China. And the way that economists measure the size of economies and compare them, it's actually on paper the case that China is bigger than the US. China is about 20% of global GDP. Now, most of that is because it has such a huge population, 1.4 billion. And the US is about 15% of global GDP based on a purchasing power parity basis. Now, if you look at it on sort of just nominal GDP, market exchange rates, it's more like US is 27% and China's 17%. So you can kind of argue the numbers, but the point is there are now two big economies in the world. And so, fast forward, it's a slightly complicated argument, but I think that we're reaching a point now where, so go to Donald Trump. He looks at it and says, hold on a minute, why are we spending 3.7% of our GDP, $1.1 trillion currently, out of that 30 trillion of GDP? Why are we spending all this money on guaranteeing the defense of Japan and Korea and NATO, which is getting bigger by the day, 31 other countries? And they're looking around, I'm looking at Germany, and they're only spending 1.5%, or France, whatever the number is. And so part of what Donald Trump's been doing is trying to get the others to sort of spend more, presumably, so that the US could spend less. And economists talk about guns and butter. We know what the guns are. The butter is domestic infrastructure, education, hospitals, all this sort of good stuff. And that is the other part of the sort of Make America Great Again, is that there are parts of US infrastructure take a trip on the New York subway. I mean, it gets you from A to B, but it's, it's a bit clunky these days. To a certain extent, say, let's spend more money on domestic infrastructure.
And asking the other country to open the market for us.
Yeah. Now, then you come to the trade, and he says, okay, hold on a minute. The US has got a low tariff, but you, China, or you, Europe, or you, Japan, either have higher tariffs, or, not on everything, but generally speaking, or these nefarious non-tariff barriers. So what I think, and then just add one more little thing in here. Donald Trump appears to be very mercantilistic in his thinking. Now, if you know economic history, that is not a compliment. If an economist says mercantilistic, that's basically, hold on, you're 200 years out of date. You've missed modern economics. But he thinks that, or seems to think, that trade should be balanced. He thinks that the US running a deficit is a drain on our national wealth, or China or Japan running a surplus, which basically means they're shipping more goods over here than they're getting from America. That's good for Japan and good for America, good for China. If anything, economists would kind of look at it the other way around and say, America's getting a pretty good deal here. We're getting all this stuff, and we give them these pieces of paper in return. So he's very mercantilistic, but he's sort of, in some sense, reacting to the fact that, why is the US providing this public good of underwriting the trade system? Everybody should be operating on a reciprocal sort of basis, and that all these reciprocal tariffs now. 90 days is not up yet. We have to see how this whole saga plays out. But that's the way I interpret what he's doing. He's trying to use this big stick to try to sort of get people in line. I think what's missing in this whole debate, Donald Trump is a great disruptor, a great sort of destroyer, but we're not having a discussion about, well, if the Pax Americana system has run its course, we need something which is more perhaps multi-polar, I don't like that word particularly, but something where there's a fairer distribution, global burden sharing. Who's having that discussion? Who's leading that discussion?
Yeah, it's just a lot of people are saying that President Trump's doing his policy has a point. Has a logic about supply chain issues, about this unfair trade. It has a point. But the thing is that it's easy to destroy old world, but it's very, very hard to create a new world. His job is just seems to destroy the old world, give us chaos. So right now it's already like it's mid of June. Since April 2nd, it started this Liberation Day. Do you think has he achieved anything meaningful? We know that the U.S. and UK just reached a deal yesterday, and do you think he achieved anything meaningful? Bring the manufacturing back and decrease the deficit and supply chain safety.
Well, Susan, you will search far and wide to try to find an economist that tells you high tariffs are a good thing. So you're talking to the wrong person. But if something good has come of this, it sort of relates to what I was saying before, that President Trump is kind of like putting the spotlight on these issues. And they're complicated issues, trade negotiations have been going on for decades. I think most people would argue that they've sort of kind of failed, and the WTO has not really worked out too well because people maybe are not following the rules. But again, I'm a little bit of an optimist. What I read an op-ed back in 2018, and I would say the same thing today, that when Donald Trump comes out with this stuff, rather than tearing your hair out, probably the better thing for other countries to do is to try to engage in a constructive way. And if this could be the catalyst for everybody to bring down their tariff rates and to try to reduce as much as possible these mysterious non-tariff barriers. In other words, it could actually be good for global trade. That should be I think we should have our eye on that ball and see if the Donald Trump drama can be channeled in that direction.
May have a happy ending.
Maybe.
Yeah, so U.S.-China trade, U.S.-China just reached a tentative deal. But I read a lot of articles that said right now, actually, just to go back where we started, right now, U.S. tariff on China is around 30%. On some goods, it's around 55%. It's just before the Liberation Day. But the sentiment is different. The perception of the relations different. And especially recently, in recent trade deal, the rare earths play a very big role. China has an upper hand in the rare earths and magnet restriction. That's one of the reasons the U.S. and China reached a deal. But do you think China holds such important supply chain like rare earths and magnet? Do you think it reinforces the narrative that United States need to move out the supply chain from China, need to have a safety of important supply chain?
Well, again, just to put that in a broader context, what has happened, and this is pre-Trump, ex-Trump, has happened in the last, I don't know what it is, 10, 15 years, is this intermingling of national security issues and concerns with sort of economic and trade concerns. And from an economist point of view, I feel a little bit that in some ways the economics has been hijacked by the national security issue. Because it's always very easy to say, well, there's a threat to national security, we need to do X, Y, and Z. It's hard to argue against that. But I think the better solution is to, so China sort of got a little bit from being a sort of a competitor, and then it became a strategic competitor. Now it's sort of morphed into an adversary, if not an enemy. And the more you move along that path, the more that you do have to start saying, well, maybe we should have semiconductors here, we should have our chain. But the alternative is to sort of try to avoid conflict, try to build as many sort of bridges as possible, and sort of minimize the need to rely on what, from an economic point of view, is going to be a rather inefficient solution to the national security dilemma. So call me, rose-tinted glasses, sort of Panglossian or whatever. But and again, I don't like the weaponization, whether it's of the dollar or whether it's of rare earths, because once you weaponize those things, so I'd have the same advice to China as I would to the US: don't weaponize rare earths, because guess what? China doesn't really have, and by the way, I'm not an expert on rare earths, but I'm pretty confident in saying China doesn't have a monopoly on rare earths in the longer term. Economists always think in short term, the situation today, medium term, once we've been able to adjust, and then the long term, when everything's adjusted. Part of the reason I think that China has a grip on many rare earths is because it's pretty dirty stuff, it's pretty kind of pollutive, and at China's stage of economic development, and maybe looking at some of the strategic calculus, they decided this is a good area to go in. But Australia has rare earths, Ukraine has rare earths, Russia has rare earths, Canada, the US has rare earths. So if China weaponizes,
the decision may backfire.
Well, it will backfire in the longer run. So so from that perspective, I don't think the more we can not go down that path and go in another direction, and perhaps use diplomacy and soft power more, and not point as many fingers, I think we'll be able to then enjoy more the economic benefits of free trade, globalization.
But sadly, I think the world is going to the other direction. Yeah, like right now, it's like not only rare earths is an issue that many technology companies, they try, before this, all this chaos, before the second Trump administration, for many multinational companies, the supply chain is China plus one, or something somewhere else plus China. But now, many technology companies, they are just avoid China. It's anything but China is now becoming the norm. And in China's side, right now, take the biggest battery maker, CATL, 宁德时代. they just had the IPO in Hong Kong. They do not allow American financial institution to invest. So that's another sign of decoupling. So do you think, with the world going to a more crazier, direction, do you think the decoupling we're talking for a long time will finally come, decoupling between us and China?
Well, so-called decoupling it's a process, and it's a kind of a relative issue. So if you think of decoupling as a total, the US and China stop dealing with one another, and they form their own spheres. I mean, that's not going to happen. Or if it does happen, we're all going to be collectively much worse off. I mean, the US is still, for China, its biggest export market by far. So I think around about 17% of direct exports. From the US point of view, the biggest source of export for the US, from the US point of view, is Canada and Mexico because of the close, USMCA and proximity, and then China's number 3, so about 7% of US exports. And if you look at the trade flows, they've certainly, in terms of, say, exports from China to the US, peaked probably around 2022 or so, and they've come down, maybe in net terms, as much as 20%. But they're still at a historically very high level, still $500 billion or something a year of exports. So these two sort of mammoth economies in the global economy, separated by an ocean, are just so big and so interlinked that complete decoupling would be, really is hard to imagine. And if you listen to US policymakers, typically what they're saying is, we don't want to completely decouple. It's a little bit of, we want to have our cake and eat it too. That is, we want to be very careful about, national security sensitive supply chains. I get that. But we still want to be able to go to Walmart and buy all the cheap Chinese goods.
That's Biden administration is de-risk, but now with Trump, the Liberation Day, with this, the trade war, people will think about maybe in the future, it's really, the decoupling will be the way to go. Maybe not. That's all.
Well, again, it depends a little bit on how you define decoupling. Will there be, I think we saw the heyday, maybe 6-7 years ago, the sort of pinnacle, if you like, of US-China trade and financial relations. And definitely things have gone south. But there will be serious costs associated with, again, a really significant decoupling. For example, if the US were to fall to 5 or 6 on the list of export markets for China, a little bit like the situation was in the Cold War between the US and the Soviet Union. They didn't really trade with one another very much. But, again, I think that it's unlikely to go anywhere near that extreme.
Do you think the US-China trade war was really about trade, or it's about something bigger, like tech dominance, like national security and global power? I ask this because I'm not sure how many people read the article in New York Times in May. The article, the op-ed title, "In the future, China will be dominant, the United States will be irrelevant." This article said China is already leading in in many areas like AI, like biotech, like EV, some area of AI, like we see about DeepSeek and then robotics. This area, China is really putting a lot of resources and very successful. So do you think China has really have the momentum to pull ahead?
Well, I think you asked the question there, Susan. Is that sort of an exaggeration? The idea that China is taking over the world and the US is going down the road. I mean, that's obviously...
It's not taking the world. It's China is leading in very key area, like artificial intelligence, not leading, but in some area like biotech, right. Definitely leading. Yeah.
And again, I'm not an expert on all the different industry sectors, but that's exactly what you'd expect.
Yeah.
That was my point before, that the change that's happening in the world, that China, 1.4 billion people, is now the largest economy in the world, and it has a potential growth. So the US potential growth would be around about, most economists would see it as about a little bit below 2%. So the US is very mature, it can really it's at the technological frontier. Let's say it grows roughly about 2%. That means the economy would double in about 35 years. Most economists would say, and again, a lot of debate about problems in China, whatever, but given the Chinese stage of economic development, now it does have adverse demographics, it's got a demographic headwind, but in terms of getting to the technological frontier and getting productivity up across the economy, you might expect China to grow over the next 30, 40 years at something like 4%, at least 3%, 4%, 5%. So if it grew at 5%, it's doubling in about 15 years or so, something like that. Arithmetic. You basically divide the growth, 70 divided by the growth rate. So if it was growing at 7% per year, it would double in 10 years. My point is that we now have these two, big economies. An economy, China, that has shown over the last 25 years, but even since the early 1980s, the ability to grow and develop dramatically. And of course, it's churning out a lot of scientists, STEM graduates, and at one point had 330,000 students studying in the US, and that's down to more like 250,000 now. But the point is, if you step back and say, where is China going? And where are the US going? They've both got very dynamic paths ahead of them. So the idea that China would get to the frontier and maybe outcompete the US in some areas is something that you really should expect. And then the question is, well, how do you deal with that? How do you manage that? How do you accommodate that? I think there's a real, if the mindset becomes, well, we can't have that. We have to beat China in every field, and China is an adversary, if not an enemy, then we run a serious risk, I believe, of falling into what is famously called, let's see if I can pronounce it, Thucydides trap. The Thucydides trap, which is when you have a rising power, a challenging an established power, you end up in war. And war between China and the US, which could progress to nuclear war, is a shocking outcome to contemplate. So, you hear a lot of rhetoric when you turn the TV on from, some politicians and others, and people that come on TV, you call them talking heads, who really kind of demonize country X, country Y, country Z. And I think that can just be, can be very dangerous. So I'm less, again, I understand the national security considerations, but I'm less concerned about, well, what if China led in this area or that area? Solar panels, or, they certainly don't lead in semiconductors. And if you look at what the US is strong at, if you look at, one metric I like to look at, not unique in this regard, is, what are the most valuable companies in the US? Well, it's Apple, it's Google, it's Nvidia, it's Amazon, it's Facebook. And if you look at those companies, none of them actually make anything. Now that's what Donald Trump worries about. But what do they make? They make intellectual property. They make the most advanced big data machines, artificial intelligence, gaming, etc., etc. So will China, catch up or do well in those areas with a big population, with so many STEM graduates? Yes, and we have all those sort of equivalent kind of firms, Alibaba, Tencent, Baidu, all those companies in China as well. But I think there's room for a lot of companies like that to flourish in the world. Who hate central banks, hate central governments, and see this as a sort of libertarian, utopian monetary system. Now, maybe that's a straw man, but I don't think that that's the issue. I don't think that Bitcoin and these other cryptocurrencies are going to sort of replace the current system. But they are a disruptor, and they are a major point of innovation, and they're already having an effect. And they may be they will, I think, be to a certain extent bolted onto the existing system. And particularly in the payment space. So I think rather than say Bitcoin per se, something like the stable coins. They're essentially a cryptocurrency version of the dollar. sometimes the euro.
US is just a past law that, regarding the stable coin thing.
Yeah, so that sort of relates more to the payment system. How do you transfer money around the world? But economists, and it's amazing I've got through the conversation this far without sort of defining money, but every economics textbook, every banking chapter that you pick up will tell you, well, what is money? It's a unit of account. Or what does it need to do in order to be considered money? It's a unit of account. That means that we measure things in dollars, in this case. It's a medium of exchange. It means when you buy and sell assets and goods and services, you use that currency. Again, we use the dollar in this country for most of our transactions. And then it's a store of value. It allows you to transfer purchasing power through time. But when economists talk about store of value, they're talking about a stable store of value, not a risky, speculative asset. Because risky assets can also transfer value through time, but you don't know whether it's going to go up or down. And if you measure Bitcoin and other cryptocurrencies from that traditional perspective, they're not really used as units of account, certainly not widely. Maybe a little bit on the internet, in native form, as they say. They're not really used as a medium of exchange. Again, there are pockets of the internet, gaming world, etc., where they are. But you come to store of value, and they say, oh, it's a great store of value. How do I know that?
Digital gold.
Digital gold?
Yeah.
How do I know that? Because the price of Bitcoin is now 100,000.
Yeah.
And the Bitcoin evangelists will say it can only go higher, and they have a whole story about that. Well, okay, let's go back to the most fundamental idea in finance, which is high risk, high return. Low risk, low return. You cannot have an asset which you think is going to just keep going up and up in value, a one-way bet, and it's not risky. So if you convince me that the price of Bitcoin in dollars is going to go 200,000, 500,000, it's a great investment, I'm going to tell you, well, that might be the case, but it has to be very risky. In other words, it might go to 50,000 or 20,000.
It is very risky.
So that's kind of I think there is a place for Bitcoin and cryptocurrencies as transfers of value, as risky assets. That's why I would talk more about crypto assets than cryptocurrency.
Yeah.
Currency has to be safer.
Yeah. I think cryptocurrency, can be seen as alternative asset. It's risky, but just like you mentioned that Bitcoin can go up, but during the process can go down a lot. Sometimes on one day Bitcoin can increase 10,000, decrease 10,000. That's happens. So, yeah.
Well, Bitcoin as again we have gold. Bitcoin as digital gold, is really is a story. It's a narrative.
Yeah.
And it's. If you look in history at all the kind of history of bubbles, which have been hundreds of bubbles, even the last few hundred years. So I'm not saying Bitcoin's a bubble, although perhaps I am. But the point is, every time you have a bubble, whether it's Japanese equities in the 1980s, whether it's a NASDAQ bubble, there's always a germ of truth, but there's always a narrative that this time is different. Ken Rogoff and Reinhardt wrote a famous book saying, this time is different, that being a sarcastic comment. And so there's this story with Bitcoin as well. Oh, there's something very different about this. But I'm always suspicious when I hear those kind of stories.